Great. So once again, thank you very much for coming, and we'll start the session right now. If you can hear me properly, and just try if you can use your chat options. Just write a yes or okay if you can hear me properly. If you can hear my audio, you can hear what I'm saying. You can see my presentation. Just write a yes or okay, and we can move further. All right. Okay. 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 Perfect. 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 Okay. Great. Everybody can hear me. Great. So just in case if there's any problem, you can always go back to YouTube. We put the recording of the webinar over there. It's just a lot easier sometimes to attend this live. So if you have any questions in your mind, you can always ask. Now, starting from how actually the psychology in trading works, and as it says, Sir John Templeton said that the four most dangerous words in the investing are that this time it's different. Uh, we go through mixed emotions when we are trading and when money is involved. And you'll be surprised to know that so many people should not actually lose money in trading as they do. 85%, 80 to 85% of the retail clients, they lose money in day trades, and there is a possibility of a loss of capital. And this percentage would be much, much less if we were just able to manage our emotions right. And when I say manage our emotions right, I do not mean that cut your emotions completely when you are trading, because that's just not possible. A lot of trading pundits, a lot of trading advisors or traders, they say that you should keep your emotions away when you're trading. And as much as one likes to do that, we always forget that we are humans, and maybe one or two or maybe 10, 11 people can do that. But to expect from everybody to cut their emotions away and bring a theoretical discipline in the trading, it's absolutely impossible. And that's why we see a lot of people, they lose money in trading. So today we are going to talk about some very common techniques, and this is not something which is for which you need a sort of certification or anything. People talk about crafting a very personalized uh, trading schedule, and that is something which anybody can do. But you need that sort of psychological plan. You have to start somewhere to understand this as a trader. When we talk about managing your emotions, we have to understand that how it actually works. People by very nature are emotional, and when we talk about how can we control it, we have to understand that the depth of emotions is not just into trading. So as it says that any game you play, whether it is football or tennis or poker, any sport you play, there is emotions involved. There are survival instincts, and then separation from emotions is something which is a very important thing, and that is not actually possible. Identifying your strengths and weaknesses. So the idea is that even if you have survival instincts, and sometimes it's always good to go with your instincts, as they say, but at the same time to expect that the emotions will take all the decisions, that's not right. So we have to have some sort of proper management of emotions. We have to identify our strengths, we have to identify our weaknesses, and for example, in a trading perspective, we have to identify that what is the most important strength of us. If we are able to read charts well, if we are able to understand charts well or fundamentals well, are we fundamental traders or are we technical traders? What is our expertise? What is our strength? Is it on one instrument, or is it the concept of diversification? And what is our weakness? Like in last 15 years, I have seen that a lot of traders, they have this weakness of booking their profits early and holding on to their losses for a very long time. So if you buy something and the moment it gives you a 40 $50 profit, you book your profit quick. But the moment it starts coming down, the trade starts coming down, you accumulate your losses, you keep buying more, you average your position, with the hope that this is going to get better. Now, this is a classic case of emotional bias, a behavioral bias, by which we hold on. We have developed some sort of loss aversion. We are scared of losses, and that's why we never book losses, but we can book quick profits. So these kind of things are traders' enemies, and that is another reason that why majority of people, because when I speak, you can feel that this is something which is very common. Maybe you're not doing it, but you must be knowing somebody who does that, holding on to the losses for too long while booking profits real fast. uh, Understanding how emotional experience and preconscious thoughts actually work. There are a lot of ways when we talk about our emotional experiences or our preconscious thoughts, because our previous emotional experiences, they play a very important role on the current action which we are taking right now. To give you an understanding, if, let's say, back in the past you have lost money in gold or in any other asset class, or let's say in any other commodity like oil, a lot of people, they do day trades in gold, a lot of people, they do day trades in oil. And if you have always, let's say, past 3 or 4 times you have lost money in gold or oil, then next time when you are trading in gold and oil, back in your mind, if you lose money, you will always tell yourself, yeah, I have lost money back in the past, so it's no big deal. That's scenario one. Because then what will happen, because you have this emotional experience back in the past, you kind of make your brain understand that, yeah, I always lose money in gold and oil. So instead of doing uh, what you did wrong, instead of making it right and learning from it, you feel that this is something which has happened in the past and I always lose money in gold and oil, so I'm never going to do it. Now that's a mistake. Scenario two, when you lose money, eventually either you stop trading in that asset class at all because you feel that I have never made money in gold and oil, I will never make money. But then that stops you from diversifying. And let me tell you guys, diversification is the single most factor which keeps you away from losing your entire capital. The last so many years of trading, and I hear a lot of clients come and say, we lost all our money in stock markets, we lost all our money in trading. It's not possible if you cut down your losses, if you have a risk threshold in mind, or if you have not just only invested in stocks. If you had invested in commodities, if you had invested in bonds, if you had invested in different kinds of stocks. I talk to a lot of people and they say that we have invested in Apple, Microsoft, Netflix, Tesla, Intel, IBM, Advanced Micro Devices, Nvidia. So our risk is divided into many stocks. But what they clearly not understand is that all these are tech companies. So last 1 year when interest rates went up, technology stocks came down. So all of those stocks were down. And yes, there could be a diversification in terms of companies. But then if the whole sector is coming down, if a whole asset class is coming down, then what's your plan B? So previous emotional experiences, they sometimes lead to formation of a present action, and that's not the right thing. Whatever emotional experience you had, you need to learn from this and then you need to move on, and that's how you manage an emotion. We can always try to detach our emotions, keep it separate, but then ask yourself this question, that is it something which is possible? Do you really are able to detach your emotions and not think about a single time the loss you just made? If you can, that's really good, but if you cannot, then at least you need to start learning to manage your emotions well. Whatever has happened in the past, take a learning and let past be the past. Don't stop diversifying or don't stop investing into an asset just because you lost money twice or thrice in it. See what you did wrong. Were you over leveraged? Were you against the trend? Did you not consult a risk expert? Did you not consult the trading levels? What went wrong? Was somebody else taking decision on your behalf? Were you not involved in your investment at all? All of these things, they do contribute to the losses in the portfolio. Sometimes we always feel that let fund managers manage the thing and we don't get involved. There's nothing wrong with it. You have a job to do, so I expect that you will not be involved too much. But then at the end of the day, this hard earned money which you have, this is earned by you. So it's your responsibility to understand where this is being invested and slowly and gradually learn about this. That's why these I've seen last 12 years, it has been a complete shift of investors expecting fund managers to do their job. Now they're trying to learn what financial markets are all about. In any part of the world, if you see now, youngsters, other sort of investors, they are getting excited about learning what this is, and that's very good because now the view of financial institutions have become much more. The perspective of the financial institution has changed from managing money to teaching investors that how it works. And of course, consultants and research always comes in. Even consultants and research is important because you can always get a lot of knowledge from Google, but sometimes this knowledge also becomes noise. You don't know what to eliminate, and we also succumb to a lot of behavioral biases which are actually supported by this noise. So, for example, if you have purchased Apple as a stock, and the moment Apple announced that they have launched a mixed reality vision headset, you expect that your stock will go higher. Now, the price of that headset is $3,500, so it doesn't make sense for a company to launch something like that currently. But they still did. But however, investors perceive this that's too expensive, and the stock starts going down. But then, if you just browse on Instagram and you find one influencer talking about how great that mixed reality headset is, you will stick to your trade because now you are seeking the information which will support your trade. And trust me, today, if you Google why Apple is a good stock, you will find 50,000 results over it. If you Google why Apple is a bad stock, you will find 50,000 results over it. So there is so much noise in the market, and that's why you need market consultants who can always eliminate the noise and tell you that this is how it works. They can teach you, and you should learn that. And I think that's the need of the hour currently. Now, next is the unconscious emotions. Emotions, as we talk about it, it's innate, powerful, and as we say that it's an unconscious process. We always put our own filter to everything, whether we see world, how we see, whether we see a person. These days, everybody has its own perspective. The concept when where people say agree to disagree is all about everybody having their own perception. Maybe for me, 1 plus 1 is 2. For you, 2 plus 2 is 2. At this point of time, the line between right and wrong has reduced because now through every influencers on Instagram and then so many platforms, people have started promoting the idea that you could be right, everybody could be right, anything is possible, everything is possible. So now we see everything from our own personal filter. And as I said, that past experiences, whatever happens, this should have nothing to do with the trading or your present approach of trading. Your past experiences should not determine how your trading approach should be. Of course, if you learn something from the past, which is valuable, that I should not take over leverage, I should have put a stop loss, those learnings can always be implemented. But as I said, what you decide where to invest should not depend on how much it passed, how bad your experience was with that particular asset class back in the past. That time was different, that idea was different, and that is the reason that why we do what we do. We have to manage our emotions well. Present beliefs governed by past experiences that are linked to unconscious emotional memories. main ingredient in developing beliefs, and re-experiencing the same or similar emotions helps to keep the belief in the same place. So as I said, a lot of times what we have to understand is what has happened in the past, it has happened. We have to make a new trading plan every day. Back in the days when I was learning how to trade, my mentors would always tell me that make a list of all the trades you are doing right now, and tell give us the reason that why you are doing it, whether it's fundamental or technical, and give us a detailed understanding of why do you think that this is the right direction. And when that trade goes wrong, you will be able to see that the reason which you gave, was that reason wrong or was that reason right? If it was right, then what happened? Why the trade went on the other side? If the reason was wrong, then you will understand that how to perceive that particular instrument. So definitely a trading journal, which we'll see again in the further, that how it works. The trader's enemies, as we say, the wicked four. And this is really, really important. So, these four factors, greed, fear, ego, and revenge trading, I think that is something which you should always be careful. If you see fear, for example, it's a very strong form of emotion, and this affects virtually to all the traders. It's not just you or me, it affects everybody. One of the toughest form of emotions also, you to deal with fear in any aspect of life, especially when trading, it's very difficult. And it doesn't matter how much knowledge you have, you could be very certified, very knowledgeable, great experience. Fear is something, it can still impair your judgment and decision making abilities. Even, I am telling you, during the times, if you have spotted a very good trading opportunity, you will still have fear. And when fear takes you over, it will make you act in a very irrational way. Like you will get stressed really, really fast, and that is really bad for your success in trading. And because, and see, the point is, fear can arise due to a lot of reasons. You can have fear of loss, right? Before you enter into the market, you will feel that what if I lose money, right? So before even executing a trade, you have this fear of loss. And if you're fearful throughout the time, if you are fearful, even during entering a position, you might uh, not be very confident during the exits. Even a small price move against your trade will make you cause panic. Now, panic, that can affect your judgment, right? So, again, as I said, fear of loss is one. Fear of following a string of losses. Like if 8 out of your last 10 trades went really wrong. So, even if you spot a very good trading opportunity, you will still be very hesitant because there has been a string of losses. So, now you are fearful. Another fear, which is fear of missing out, FOMO, as they call it. Now, that is something which has happened a lot. Like if a stock, for example, went up strongly, everyone around you is buying that stock. Now, that might trigger you to decide to buy the stock yourself also. Even when your analysis suggests that stock is overvalued, you will still enter because now you feel that you're missing out on the opportunity. This happens with Amazon, right? Amazon rallied from 102 to 140 after earnings. Now it is at 140. Now a lot of traders I know, they entered at 140. Now today the stock is 134. So fear of missing out, it's very important, and it's something which can makes you do a lot of trades which are not worth doing, right? And then again, you talk about there are a lot of other factors which gives rise. So basically, what sort of impact I can tell you that fear have on your trading decisions? You, if you are making trades, if your trades are making profits, basically you're winning trades, you cut your winning trades way too early due to fear that price might reverse. So let's just close it right away. You don't stick to your target. Or sometimes you enter into a trade way before you should enter because you are missing out. You're scared that I might miss out on the price move. Sometimes you enter into a trade too late because you were scared, right? Sometimes you don't enter into a very good opportunity because you're scared of capital loss. right? So all of these things, sometimes you don't enter into a good trade because last 5 trades have gone wrong. So even if it's a good opportunity, you're not. All of these things, the fear is not good for your trading. So I'm not saying that be careless, but then learn to manage your fear, because that's really, really important. Similarly, greed is, so the problem is, fear means extremely too much cautious. So cautious that you are just scared to enter at all. Greed is opposite of fear. Now greed is, you will hold on to your winning trades now for too long, because you want to make complete profit, you want to make entire profit. And if, for example, you had a string of winning trades, you get overconfident and you take a lot of risk without even thinking, you take over leverage. Like, let me give you an example. Let's say you, as a trader, for example, you executed a buy order at 100, you placed a stop loss at 95, you put up a take profit target at 112. Now, let's assume that trade went really well, and as expected, your target of 112 is reached. Now, however, your target is reached already. You feel, and your system shows that it's a good time to book profit. You, as a trader, will get so greedy for more profit, you will not close your trade. You will hold on to that position. Now, this is greed, because now this is clouding your judgment, right? Now, opposite of fear, right? In fear, you take very little or at all no risk, but in greed, you, the trader, it takes very excessive risk. So it would not be wrong to be occasionally greedy, but then allowing greed to influence your decision, and despite warning signals generated by your system, not revising your stop loss, it can be a very big disaster. So this is something which is really important, and it's a very, very common emotion. It develops very late in the bull market. Price goes up, it goes up, and more participants, they join the rally thinking that, now easy money is being made. So the collective greed of all the market participants eventually cause the market to top out and eventually start coming down. So that is something which we definitely should understand. And again, there is hope, there is ego, as we can say, because there is overconfidence, there is frustration, there is anger. A lot of times we see that there are regrets. Like, as an emotion, regret is something, it's not just in trading, even in your life. If you have regrets, then there is something which you have to take care of, because in your life, there could be disappointments, but regret is an emotion which always holds you up. And that is something, it could be in trading, it could be due to various reasons. Like, you regret after exiting from a profitable position, because you saw that price continue to rise, so you are thinking now that, shit, I closed this trade way before early. So now you have a regret that I closed this position too early. After you closed a profitable position, again, now what you regret, that I just did 10 ounces of gold, I could have done 100 ounces of gold. Regret. If you cut your losses, then you see your stop loss got hit, and then now the price has reversed, so now you're regretting, why did I put a stop loss at all, right? So now, sometimes you find a very good trade setup, but then due to some reason you did not execute the trade. Later on, trade worked really well, so now you have regret that why you missed the trade. All of these things, regret is not something which is good for your trading, because these are just few examples where trader could sense that emotion of regret. But then, unfortunately, regret is also something that traders do face every now and then. And it's important to not let this emotion have a bearing on your future trades, because it's a very bad mistake that you could make, is to allow regret to get the best of you. Because if this happens, more likely your next trade will be based on a very emotional, not on a very rational thinking, on a very emotional thinking. So I'll give you an example, because this happens a lot of times. Let's say you found a very good trade in a stock. Now, because of fear of loss, you decided in the last moment that you're not going to do it. Now, trade worked out really well, but you were not a part of it, and it went up even higher than your trading price. So now you are in a regret that why you missed it. Now, because you are regretting, the next trade which you will take, you will be wanting to earn profits which were missed in the previous trade. And now in the next trade, you are looking emotionally to take that particular profit. And it's a very poor setup, right? Trade doesn't work out. It affects your mental well-being eventually. And now again, you have, because you have allowed regret to influence your trade decision. So it's very, very important, guys. Ensure that every trading decision you take must be independent of the success, right? Overconfidence, frustration, anger. A lot of times, clients have frustration and anger when they are trading. So they start doing revenge trading. So you took a trade once, it did not work out. You are so upset that the moment your stop loss got hit, you enter into a trade again. That how can I be wrong? This is, and then when you enter to cover the previous losses. So you take a much bigger quantity, and now you're not even looking at the trend because your mind is just clouded by a feeling of revenge. So you go high leverage and you're like, okay, it's okay, when if I lose it, I lose it, but I'm going to either make big money or lose big money. I'm okay with it. So these kind of, and I'm not even joking, guys, I've seen a lot of clients doing this. Even after us explaining them, telling them, emotions do get the best out of them, and that's why we are having this session today. Because this is, and I'm sure this is not something which is very rare information or a knowledge which you never had. I think all of us, what makes this session very special is that all of us experience this in our daily lives. So all we are talking about is, let's be careful and let's manage these emotions well. And as I said, behavioral finance is it's like a study, and it's a very important study. If you search the same biases which I'm going to talk about, it's a study of the psychology of a trader, and how the investors, how the financial analysts, even the best of the fund managers, they sometimes get influenced by what's going on. So we always feel like, a lot of times, the older economic assumptions and economic theories always assume that investors are always rational. If you take out any economic theory, whether it is Keynes or anyone, they always assume that investors are going to act rational. But behavioral finance, it focuses on the fact that investors are not always rational. They have limits to self control, they're influenced by their own behavior. So that is something which we'll discuss today. Let's understand what are these top 10 behavioral biases which we see. And this is something which we hear a lot of times. We are talking about overconfidence, we are talking about self-serving biases. Now, there is something which is, we see a lot of times, and this is not something, if I start giving you examples of this, you will realize that this is not something which we haven't faced before. This is something which is there. And then these are emotional biases also. Like, for example, if I'm talking about overconfidence, there is some sort of self attribution or some sort of self enhancing which happens. Like, sometimes when you make a profit on your trade, you're so overconfident about it that you start praising yourself. You give too much credit to your success. Even when sometimes when you are lucky in the market, you know that you went lucky, but because you made a profit, you feel that you know everything. But when you book a loss, then you start blaming the market, right? You basically try to self protect. So overconfidence has, it's a very, I mean, the word itself is self explanatory, but you have to understand it involves a lot of self enhancing and a lot of self protecting. Always remember this. When you are making profits, it's a lot of self enhancing. When you are making losses, you are protecting yourself. There's a lot of self protection. So this is again something which we should definitely understand. And as I said, uh, a lot of practice is needed, because the consequences, if you are overconfident, you will underestimate the risk, and you will not, like, you will have very poorly diversified portfolio. So the risk from the downside could be very, very significant. right? So that is something, again, you should mentally separate your good money making decisions from your bad ones, and then review these decisions. Try to see exactly what you did correctly. Did you purchase an investment at a particularly advantageous time, or it was based on fundamentals, or you just had pure luck that markets were going swinging higher and you entered into it? So, and when you are looking at your losses or unprofitable decisions, look for patterns, look for common mistakes, right? That maybe you are unaware you are making at this moment. So this is something which is definitely going to help you out, guys, because these emotions, they these biases, they are real. And any biases which you see over here, it's not something which is any different from what we understand. So look at this. Like, for example, there is overconfidence, there is confirmation, narrative fallacy, hindsight. If you see, hindsight is one of the most talked biases, and you will see why. Because hindsight is something which everyone goes through, and not just in trading. Hindsight bias. It So basically, I'll tell you what it is. Uh, like, for example, believing something that if an event has occurred, you start believing that, yeah, this was very predictable. Like, the when people say, oh yeah, I already expected this is going to happen. This is called hindsight bias, and this comes from the obvious fact that something which the results which occurred, and it went against you, you tend to tell yourself that, yeah, yeah, you know what, this had to happen. And all your poorly reasoned decisions, these are these poor results which mostly have hindsight biases. Like, for example, if you lost money in a market crash in financial crisis 2008, for example. If you have lost money in 2008, and you're saying that, you know what, I could see this crisis coming. If you could see this crisis coming, you would not have lost the money. Instead of acknowledging what you did wrong, you start predicting that, yeah, everybody was talking about crisis. I also knew crisis was coming. You still lost the money. So what is the consequence when you're going through this hindsight bias? You overestimate the degree to which you correctly predicted an investment outcome. You feel that you know everything. So if, let's say, for example, you predicted the outcome of an investment is going to be positive and it went positive. Similarly, what happens is, because you are going through hindsight bias, you overestimate your ability that you can predict something right and wrong. This is very, very common. I meet a lot of clients and they say, I've been looking at gold from last 20 years, and trust me when I tell you that gold prices are going to go up. This is overconfidence followed by hindsight, right? Because this hindsight is very closely related to overconfidence bias. If you search for it, you will see hindsight and overconfidence is back to back, right? So again, as I said, that there are a lot of these biases which you should definitely look at, and we should be very, very careful, because we should not allow these kind of biases to rule us. And the thing is, this can happen with any fund manager, this can happen with any investors, anybody who's certified or anybody who's very experienced, they can fall into this. So this is not something which is very, very new. This has been there for a while, and that's why you need to be very careful. A few other biases, if I were to tell you: herd mentality. If you can see herd mentality, this is so common. Like, sometimes when I ask clients that, why did you buy or sell? I bought because a friend of mine, he said that this is a good stock and he bought it. Or sometimes they say, yeah, us three, four people, we invested in this together. Everybody feels this is a good stock to buy. The foundation of the research is what we are asking, not that how many people feel that it's a good buy. So herd mentality is very common. Just look back at your investments and tell me how many times you invested somewhere because somebody else asked you to do. If it worked out well, very good. But if it did not work out well, then what's your plan B? Right? What did you learn from this? You have to learn that, okay, not everything what other people tell me or other my friends tell me, it's not right. I have to do my own research. I have to do my own understanding. And that is the reason that why we should not develop this herd mentality. If you see, there is one more bias here, which is called framing bias. Framing is also something which is so common. And again, if you start looking for these biases, you will find a lot of information on them, and you will realize that how we are already. So for example, if you're going through this framing bias, you're so focused on short term price fluctuations, which may result in a very long run consideration. Your decision making process is completely ignored because you are so focused on short term price fluctuations, and you're not able to identify your risk, right? Because this is something which is really important. Now, to basically make you understand how framing bias was, it's a very uh, so to give you an idea, like let's say it's a very information processing bias. Now here, if for example I ask you that, let's say a situation is presented with with an idea that I will ask you, are you an aggressive investor? Now, here you say that yes, I am an aggressive investor, but at the same time, the moment you start making a loss, it clicks in you that I cannot take losses, right? Also, sometimes we see information in a way we want to see. Like, let's say, for example, if Elon Musk, for example. So a lot of years Tesla was not earning any money, but all people which were investing in Tesla just would see Elon Musk. So you focus solely on the company's executive management team, overlooking or even dismissing other areas like fundamental, their performance, their valuation. This happens so long, and it happens so many times, right? Sometimes you hear yourself saying that this company is good. Why? Because this guy, he knows how to do it. You don't look at the balance sheet, you don't look at the valuations, you don't do your research. You're like, oh, this company belongs to Elon Musk. This is definitely going to do well because he knows how it works, right? So that is something which you should be protected from, and you should protect yourself from. That's not the right approach. You don't look at a person, oh, it's Steve Jobs' company, is definitely going to do well. No, it's not necessary. Did it do well is one thing, but it's not necessary. So when you are looking at a company, please look at their fundamentals, look at their balance sheets. Numbers don't lie. So always look at their balance sheets and then take your decision, rather than taking your decision in a way that just just to satisfy yourself, because that's not the right thing. And again, as I said, so many things. For example, there are so many biases which comes in. Loss aversion. If you see, a lot of people go through loss aversion, and because this is a very common tendency that everybody just prefers avoiding losses and book profits. A lot of financial managers, if you see, they accept more risk to increase gains, but not to cut down their losses. Now, if you see, a lot of times, and this is something, as an investor, if you're going through this bias, loss aversion, you hold on to your losses too long because you don't want to book losses. And the moment you see that your stocks are making money, you quickly book and book profit. So the moment you see green, you close your trade. The moment you see red, you add on to positions, hold on to it. So this is something which is, again, it's a very common bias which happens. And this is also something what they call it as a disposition effect, where you hold on to your investments which have experienced losses for too long, but the moment you see investments which have even experienced smaller profits, you quickly sell them. So this disposition effect, this should stop, because the consequences are very severe. You hold on to losses for so long, and then what you do is, how many times you have bought something, it went in a loss, and then you hold on to it saying, oh, this is my long term trade, right? So the moment you become like this, which means, so they say in a trading language, they say every long term trade is a short term trade gone wrong. So please don't be a party to it. You should know that it's time to cut my losses and get out of it. Or if you are holding your losses for this long, you should hold your profits also for this long. Right? It should be a proper 1:2 risk reward ratio, not otherwise. So that is something which, guys, we should definitely look at. These are very common biases which we are looking. Just to give you an idea, uh, we see investments in a very, like, we see traits in a way that entry and exits are very much defined. We also have to understand that within biases, what we have, so many biases and so many biases which we just talked about: hindsight, loss aversion. These biases, they don't allow us to diversify freely, and we have to understand that every asset class, every economy goes through a phase, and during that phase we should be investing into an asset class which favors that economic phase. Like when we are impending recession, luxury stocks will not do that well as much as the consumer utility industry will do. Right? In a recession, you may not buy a very luxury product, but you're still going to pay your electricity bill. So we should invest into those kind of companies. Now, a common investor psychology: when the markets are at peak, they enter and they buy at peak. Then price starts coming down. Now there is a contraction, everybody is regretting it. The moment recession comes in, the moment everything is down, now you can't do anything, so you book your losses. And the moment you book your losses from recession, when expansion starts, again you have instant regret that I just booked my losses. And then when the expansion starts, you start feeling that maybe the markets are going up now, and it takes time again, and the moment the market reaches at peak, again you enter into the peak. So stop this cycle, realize where you are in terms of market understanding. And again, as I said, that's why consultants and risk experts are needed. You need to understand the idea that why investing is important in different economic phases. There is something, somebody asked me that what is the biggest risk in investing, and I said that the biggest risk in investment is the risk of not investing at all. I'm surprised when some people say that this is not a good time to invest. Every time is a good time to invest. It's just when you are at the bottom, buy less. When you are at the top, sorry, when you are at the bottom, buy more. When you are at the top, buy less. So there are a lot of ladder portfolios created where you can actually deploy a very smaller percentage of your capital if you're expecting that the markets are going to drop. And once it starts coming down on a matter of 5 to 10%, you start deploying your capital slowly and gradually, and pick your companies right with stronger valuations. So a lot of people can assist you with that. Right? And then, as I say, that there should be a trading position. Never add to your losing positions when you are trading, especially when you are day trading. Always determine a stop loss and a take profit. And as I said, that do not keep changing your stop losses. If prices are coming down, don't keep stretching your stop losses. That's not something which you should do. And again, as I said, uh, don't suddenly think that you can pick a price and exit. Your entry and exits should be absolutely planned. A disciplined routine is when you determine the market trend, you check the support resistance levels, you decide whether you're going to go long term or short term. Please make a trading plan for yourself. Whichever trade you place, write it down that why you are buying or selling it, whether it is fundamental or technical, it doesn't matter. Write it down that why this is a good trade and what is the duration of your trade. Is this something which you are going to be doing for a shorter time period, or is it something which is your long term trade? Right? Uh, Please stick to your risk reward ratio. And again, last one, come to us for a cup of coffee and let's discuss again how to do trading in a much more disciplined way. And when I say discuss, I just mean discuss. At the end of the day, there are several companies which can provide you a platform and allow you to trade, just like we do. But at the end of the day, that's not our objective. Whether you trade or not, with us or not, the idea is please come sit with us and just learn how to have a disciplined approach. Use a dummy account. I see there are so many demo accounts which I've prepared, and I always tell my clients, please use one before you look into the real market. And we should craft a very personalized trading psychology plan. Do a self assessment, look at what are your strengths, what are your weaknesses, right? How your past trading experience has been, so you can identify your risk tolerance, what are your emotional triggers, what is the behavior pattern, how it has impacted your trading decision. Then have a very defined target for profits. Manage your risk well, right? Be the If your objective is well defined, you will be very motivated and you will be very clear in your mindset. Risk management, please always remember, a day trade without a stop loss is definitely a bad idea. Risk management and only trading in one asset class, what people say that you don't marry your instrument. Please diversify into different asset classes, learn about different asset classes. Don't put all your eggs in one basket. And choose a trading style. Are you a day trader or are you a swing trader? Are you a position trader? Right? Select a trading style, what suits you the most, and it depends on how much time you can give. And please create a trading plan. Always keep a journal where you can record your trades. That's a really, really important. Motivate yourself and continue to learn, guys. Continue to learn. So many people have joined this webinar, and I'm so happy that today we have discussed something which not many people talk about. This is something which is written in the books, but I am sharing all these stories with you, which I have seen in last 15 years. Clients have gone through these mistakes, and it's not just clients, it's fund managers, it's all of us. I have gone through a very terrible phase where my emotions uh, would get the best out of me, and would get the best of me, not best out of me, would get the best of me, and that's just so bad. Because in the events like Brexit or US elections, when already markets are so volatile and there is so much uncertainty, you can't be ruled by emotion. So that is something which you need to be very, very careful. And again, be adaptable. Sometimes it's good to be prepared to adapt your plan as you gain more and more experience, right? Be flexible. Don't think that this is something which has not worked out for me in the past, so this is not going to work now. Be flexible, accept new things, accept new asset classes. Things have changed. 10, 12 years ago, there were a lot of things which people didn't know about it, but now they know, they trade, right? Technology, 10 years ago, technology stocks were not that great, but 10 years after, look how technology has moved. Trillion dollar companies, right? So this is something which is really important, guys. So uh, I think there are a few questions here. Somebody just said that if we want to have a one-on-one trading session, how we can do it. Just talk to your RMs, guys. Just talk to your guys who have sent you this link, and they can definitely connect a direct Zoom call, or as I said, we can always sit for a cup of coffee. Please come to the office and we can definitely assist you. Please review us on Google if you like this session. This only motivates us to conduct more and more sessions. Today was on behavioral finance. Next week, probably we'll do some trading strategies, some portfolios, and this is something which we do week on week. So that's really, really helpful for us. Please send your reviews, your feedback, whatever you like us to work on, and we'll definitely do this. Another question: can we get the discussed demo account? Yeah, I think that's very easy. Again, just be in touch with the relationship manager who has reached you out, and definitely you can get a demo account as well, and practice in the demo account. I think demo account is one of those things. It definitely does not guarantees whether you're going to make profit or losses in the live account, but it makes you familiar with the price movement of so many asset classes. So I think demo account is a great way to learn about new things. Forget about whether you will make a profit or loss. At least you will learn that how much gold moves in a day, how much a stock moves in a day, how much your index moves in a day, how many of you actually trade into German and European indices, right? Instead of US. So be open to those markets, see how much they move. And the moment you start diversifying your portfolio, you will see the change. in your trading strategies, you will see the change in your portfolios. So yeah. Do you have any strategies which we can discuss? So we do a very separate session on strategies. We make a lot of ladder portfolios. We do a lot of pair trades, and we discuss those with on sessions. So next week probably or a week after that we'll have a session on trading strategies. But then if you're interested and want to know more about these strategies, please come to our office or book a session one on one. I can discuss those portfolios with you one on one. Today's session was more about understanding the psychology of a trader. If you want to know more about what sort of strategies can be employed, definitely I'm open for a one-on-one discussion. Just reach us out and we'll definitely sit together. Right. So perfect. Yeah. So I think these many questions. Thank you so much once again, guys. This really means a lot to me. A lot of you have showed up, and I think the next thing what we need to do is just continue to learn more, continue to understand about markets, not get scared, do not have that fear or greed, or don't trade in revenge. Let's try to manage our emotions well. Let's try to keep our past experiences in the past and learn from the mistakes and move on. Right. So once again, thank you so much. My name is Yogesh, and you have a great night ahead. And we'll meet next week with a different topic and with a whole different approach.